All right, let's dive in. We are going to decode what's called the fundamental canon of accounting. Think of it as the official rulebook for the language of business. It's this universal system that lets companies all over the world talk to each other with total clarity and hopefully integrity. So let's see how it all works. It really all boils down to one simple but incredibly important question. When you're looking at a company's financial report, how in the world do you know if they're actually telling the truth? How can you really trust that the profits they're claiming or the assets they say they own are for real? Well, the answer is that business speaks a language. And just like any language, it has rules of grammar, a core set of principles that make sure everyone is on the same page, speaking clearly. These rules are exactly what turn a bunch of raw numbers into information you can actually trust. So let's start with Section 1, setting the stage. Think of these as the foundational assumptions, really the bedrock that the entire structure of accounting is built on. First up, we've got the business entity concept. This is rule number 1, and it's simple. The business is its own person. It is a completely separate entity from its owners. Its bank account is not the owner's personal piggy bank. Every transaction is recorded from the company's perspective. And that separation, that's the first crucial step to having clean, objective books. Next, we have the money measurement concept. All this means is that accounting only cares about what can be written down in terms of money, dollars, euros, you name it. It focuses only on things you can quantify. Look, the incredible skill of your team or the loyalty of your customers is hugely valuable, right? But you can't put a precise dollar amount on it, so it doesn't go on the balance sheet. And as the source material kind of humorously puts it, feelings, vibes, and emotional damage sadly don't go in the ledger. It's a funny line, but it really drives home the point that this whole process has to be grounded and objective. Then there's something called the cost concept. So let's say a company buys a building. It records that building at the exact price it paid for it, the historical cost, not what they think it might be worth today, and definitely not what some real estate agent guesses it could sell for next year. Why? Because the original cost is a hard, verifiable fact. It stops people from just making up values and keeps the whole story rooted in reality. And rounding out this section, we have the going concern concept. Basically, we make a big assumption that the business isn't going to shut down next month or next year. And this assumption is absolutely vital. It's what lets us do things like depreciate assets over many years and plan for the long term. Without it, the whole system would just collapse into a constant state of panic, like a fire sale. Okay, that brings us to Section 2, the rules of the game. Now that the stage is set, these are the core mechanics for how we actually record and process all the financial action. Now, this next one, this is really at the heart of everything. It's the dual aspect concept. You can almost think of it like a law of physics for accounting. For every action, there's an equal and opposite reaction. Every single transaction has two sides to it, a debit and a credit, that keeps the entire system in perfect, elegant balance. So what are these two sides? Well, you can think of debits as what the business receives and credits as what the business gives. It's a constant give and take. For instance, if a company buys a new laptop, its assets, the laptop, go up. That's a debit. But at the same exact time, another asset, cash, goes down to pay for it. That's a credit. See? A perfect, beautiful balancing act. And all of this leads to the most famous formula in the entire field, the accounting equation. Assets equal equity plus liabilities. It means everything a company owns has to be balanced by who has a claim to it, either the owners themselves, which is equity, or outsiders like a bank, which are liabilities. And this equation, it must always balance, no exceptions. Now for a really big one, the accrual concept. This is huge. It means we record business activity when it actually happens, not just when cash finally moves. So if your company does a job for a client in December, you record that revenue in December, even if the client doesn't get around to paying you until February. This gives a much more accurate picture of how a company is actually performing. And you can't really have the accrual concept without its perfect partner, the matching concept. This one insists that you have to record the expenses you paid to generate some revenue in the very same period as that revenue. So the cost of the parts for a product you sold in December also gets recorded in December. This direct matching is exactly how we get to an accurate measure of profit. So, we've got the rules of the game. Now, how do we make sure people are playing fair? Well, that brings us to Section 3, keeping it honest. These are the principles that kind of act like the system's conscience, making sure the numbers aren't just balanced, but also fair and trustworthy. This all starts with the concept of prudence, which you'll also hear called conservatism. Accounting basically has a sense of caution built right into it. The rule is simple. Don't get ahead of yourself, don't overstate how great your assets are, and don't overstate your income. It's really just the professional version of don't count your chickens before they hatch. And here's how that plays out in the real world. You should recognize a potential loss as soon as it seems probable. You have to account for the bad news early. But again, you only get to recognize a gain when it is actually realized, when the deal is done, the ink is dry, and the money is yours. It's this deliberate imbalance that keeps financial reports from being way too optimistic. Next up is the objectivity concept, which I like to call the show me the proof rule. Every single number that goes into the accounting books has to be backed up by some kind of verifiable evidence, an invoice, a bank statement, a receipt. This completely eliminates guesswork and demands hard proof for every entry. And to make all this data useful over time, we have the consistency concept. This just means a company has to pick its accounting methods and stick with them year after year. If they don't, then trying to compare this year's profit to last year's is totally meaningless. This rule ensures we're always comparing apples to apples. And that leads us perfectly into our final section, number 4, telling the whole story. Because, you see, it's not enough to just have accurate numbers. They have to be presented in a way that's complete, clear, and actually useful to someone. This last little group of principles makes sure the final reports are really effective. You've got full disclosure, which means you can't hide important details in tiny footnotes. There's materiality, which says to focus on the information that could actually change someone's decision. Comparability ensures you can, compare statements over time. And finally, understandability means you have to present it all clearly so someone who knows what they're looking at can make sense of it. So when you pull all of this together, everything from the business entity concept all the way to full disclosure, you start to realize these aren't just a bunch of random rules for bookkeepers. They form this incredibly powerful global framework for trust. It's a shared grammar that lets investors invest, banks lend, and businesses operate on a level playing field built on credible information. Which, of course, leads us to the final critical question. We've just walked through how this entire system is brilliantly designed for clarity and for trust. So, what happens when those rules get bent, or when they get broken entirely? Well, that's when the story of accounting gets really interesting.